It's been a much better week for equities. Stock markets have risen on each day of this week, which is the first time for many weeks that we've seen some positive cheer coming back to stock markets. The reason, well, broadly it's to do with Greece. The bailout was approved, the vote approved the austerity drive, which is the condition for which the money would be injected into Greece to avoid a default. As a result of that, we've clearly seen a positive reaction across most asset classes and risk appetite has increased. So let's just take a look at some of the charts that reflect some of these moves this week. I'm going to start with the Greek bond. This really just shows how the value of the bonds over the course of the last 6 months has steadily declined from a nominal value of around 80–85% down to a low of 50%, which was seen during the mid part of June. And we can see here that the impact on the bond as a result of the bailout has been a sort of steady, well, quite a nice jump in the value of the bond, and that has obviously been reflected across other asset classes. So let's take a look at equities. This is the FTSE 100, and we can see there an incredibly sharp bounce in the FTSE 100 over the course of the week. So having been teetering around that lower end of the range, which we highlighted over the past few sessions, or past few weeks of podcast, that 5600, 5700 range, last seen around the time of the Japanese earthquake, sort of working its way down there, snapback reaction, taking the FTSE virtually back to 6,000. Just probably shows one of two things. I think probably a lot of people are positioned quite bearishly for this group vote, very cautiously, and as I say, it really has enabled money to come back into the market very, very quickly. We were also aided somewhat by an economic number, the Chicago PMI number. And this was, again, we've mentioned over the course of the last few weeks how US data has been universally negative, but that number did surprise to the upside. So it came on a week where one was accepting of good joy, and that number was very well received as well. So just goes to show how quickly markets can bounce once this is out the way. If we also just turn now to the currency, the euro is obviously the currency of interest at the moment, and that good news has helped the euro to strengthen somewhat. We now can see the euro versus the pound starting to head into new higher territory here at the moment. It's nudging €1.10 to the pound, which is making travelling to Europe going to be very much more expensive over the course of the summer. If we now look at some of the stocks that are moving, I've been quite impressed with the performance of Rio Tinto and broadly some of those big mining stocks. We have seen a situation where since about April, commodity prices have generally been on the decline. But the mining stocks, in fairness, have really kept quite a resilient performance in light of that. I've been impressed with how little they've come back from what has been a strong peak. And as you can see here, they've been one of the major responders to this news this week, with Rio Tinto jumping 10% or so over the course of June, and really getting quite close back to those sort of year highs at the moment. That's got to be good for London. London has a very strong representation in resources stocks, to see some of those stocks moving. Hasn't been all good news. I like to sort of just bring sort of some of the more negative issues that are taking place at the moment. Premier Foods, a smallish company, owns brands such as Branston Pickle and Hovis Bread, announced quite a severe profit warning this week, and it's just interesting how it's highlighting some of the trends on commodity prices, particularly soft commodities. The price of soft commodities has been rising significantly over the course of the last few months, and it is impacting on the suppliers. They're clearly not getting the cost at the front end, so their customers, the people at Tesco and Sainsbury's, are certainly getting much tougher with their suppliers at the moment, regardless of the fact that they have these cost squeezes taking place. So whilst inflation at the moment is being held at the consumer level to some extent, it is being sort of absorbed by the suppliers, and that really is the impact that we're seeing on Premier Foods this week. With the higher euro, there are some stocks in London that benefit from a higher euro, and I've highlighted Smith and Nephew here. as a stock. You may recall that earlier this year this company was in bid talks. Those bid talks haven't really come to much at the moment. As a result, the share price was gently declining down to the 640 level. But the strength of the euro should be a big positive for a stock like Smith and Nephew, and as a result of that, they've seen quite a big bounce. The final stock for this week, which I think is worthy of mention, is Lloyds Bank. Lloyds had their strategy day held on Thursday, and I think that was very pleasingly received. The stock jumped by about 10%, one of its biggest moves it's seen for the last couple of years. There will be cost cuts, but I think overall the message was one of still stability within Lloyds Bank. Those shares, which we again highlighted over the last few weeks, were trading well below their net book value, are rapidly reclaiming that level. So a pop up above 50p has been seen this week, and it feels like with the more stable economic environment, good growth numbers, that the market is poised for a good second half, and I would expect some of these financial stocks that have been woeful performers in the first half may well be the play for the second half of the year.